Good afternoon. Welcome back to Moneycontrol's live stream. You're watching Closing Bell with me, Lavisha Darad, and my colleague Yatin Mota. Well, what a smart recovery for the markets today, Yatin. After starting the day weaker, we saw a trade which was turned out to be flat, but we saw pickup in the second half, and Nifty rose above that 24 to 50 levels. Though we were eyeing at 24,350, but of course, definitely some good attempts were made as well. Sensex also rose over 1% from day's low and reclaimed that 80,000 mark. So a positive start indeed for the December series. Buying was seen on both the days, except FMCG and the PSU stocks. All indices fared well as well. But definitely realty stocks, that were the clear winners of the today's trading session. Apart from that, even auto index that rose over 1%, nearly 1% after the November sales figures that came out mixed. Yatin, the rub-off effect of slowing second quarter GDP print was visible in the first half, but markets moved past it. It let go of the negative news flow and concentrated that the second half would be fairly better, given there is a pickup in the capex and infrastructure spending as well.
I think one point to remember, Lovisha, is that the markets look forward. The weekend GDP data spooked a lot of investors, but more or less was already captured in the Q2 earnings. We saw that the demand was considerably slowing according to the commentary of the management. So the markets probably knew a lot of things about the Q2 GDP data and growth numbers in advance. Looking forward, H2, which is the second half, looks good. And probably the markets, after the initial knee-jerk reaction and panic by weak investors, saw some good march up in trade. In fact, as you were mentioning, 150 points up for the Nifty end of the day. Advance decline ratio looked healthy at 2:1. And if you look at the sectors, real estate, metal, media, all of these stocks gained fair bit, anywhere between 1 to 3%. So a lot of stock specific action on Dalal Street, digesting that bad news and probably looking forward in the second half of the earnings season.
That's right. If you look at some of the Nifty top Nifty gainers and losers, we have Ultratech Cement that is topping the Nifty 50 chart. Well, this came after certain brokerages have pointed out that there could be a certain recovery for the cement companies from the second half of the fiscal year. So quite a bit of an upgrades coming in for a lot of cement companies across. Apart from that, we saw Apollo Hospitals, Grasim, Shriram Finance, and JSW Steel also doing well on the Nifty 50 pack as well. If you look at some of the Nifty 50 losers, well, some of the private life insurers, just for example, HDFC Life was topping the Nifty 50 losers pack, down about 2% in today's trade, whereas NTPC, Cipla, SBI Life, they also did not do well. Cipla, of course, after the block deal that we saw today, it is down about 1% in today's trade. HUL also lost over 0.5% in today's trading session, even after it guided for double-digit EPS growth for the near term. So quite a bit of shakers and movers for the Nifty 50. But on the broader end of the markets, that gained 2 to 5% last week, and today also they continued their outperformance. Yatin, what do you make of the broader end of the markets?
Hmm. The broader end of the market was healthy. In fact, if you look at stocks like Castrol, Affle, Intellect Design, the mid-cap IT stocks are really doing well in trade. What was also doing well in trade is Dixon Technologies after they announced one of their subsidiaries tying up with a company for manufacturing Google Pixel phones in India under the China Plus One strategy. Keynes Technologies, also another EMS company, gained nearly 6%. Anantraj looked buoyant in trade, 6% higher, after MK initiated the coverage on the stock with more than 30% upside from the current market price. IGL, MGL, Suzlon, Godrej Properties were the other stocks which gained anywhere between 4 to 5%. On the losing side, Aegis Logistics was down 8%, Basaf down 6%, Adani Total Gas witnessed some profit taking, was down 5%, and stocks like MapMy India, Poonawalla, Credit Access Grameen continue to languish in trade. But yes, it was a great trade overall. The mid caps and the small caps doing relatively better, specifically versus the markets.
Of course, the great day, and let's move on to and break down some of the stocks that were in focus in today's trade. Well, first, of course, like we were discussing about the Ultratech Cement, which was one of the top Nifty gainers. Well, after Ultratech Cement, even all other cement stocks were also rolling in today's trade. Now, this came on the back of optimism, which was stemming in after government's renewed capex plans are back in focus on the street. After we saw solidified victory of BJP in the Maharashtra Assembly elections, the government's capex plans and the thrust towards infrastructure spending, once again, they have regained the investors' attention on the street as well. Now, this comes on the back of Jeffries. Jeffries has come down with its report saying that Indian cement companies are expected to recover in the second half of the fiscal year as prices are expected to bottom out and demand situation would improve from here on. Well, Jeffries expects 8 to 10% year-on-year volume growth in the second half compared to a flat growth in the first half. Among its top picks, Jeffries has picked out Ultratech Cement from the large cap space and JK Cement from the mid cap space. Now, the first half, cement demand was relatively stagnant due to impact seen of the general elections as well as extended monsoon activities. But the second half could see some improvement. That's what the street is estimating from here on, because they expect the capex plans to improve, the infrastructure spending to improve from here on. Yatin, since about 30% cement demand comes from infra-related activities, the word on the street is once again buzzing that infra spending will rebound. We could see growth from here on. What do you expect could happen from here?
So I think with the GDP, doing better in second half, the GST collections also helping the government to mobilize funds and spend more on infrastructure in the second half is good. In the first half, we saw the monsoon also extending, which really slows down the construction activity. So second half, when the winter sets in India post the wedding season and the important sowing season, we have infrastructure activities which usually pick up. That drives the cement demand. Not only that, a few brokerages that I was talking to are expecting a 20 to 25 rupees per bag kind of a price increase for cement in the month of December. Obviously, this is the start of the week, start of December. So it will be later known that how much are cement companies looking to, in terms of price hikes for cement products. Usually, the market whisper is that 20-25 rupees, at least for West and North India, could be in the offing. That would provide some strength for the cement sector. In fact, for the last 2-3 trading sessions, cement stocks are really buzzing on the anticipation of a possible price hike coming in for the month of December.
That's right, coming in for cement stocks. But let's move on to the next stock in focus, which is your RBL Bank. The stock hit a fresh 52-week low and settled lower for the fifth straight day as well. Well, RBL Bank, the negative sentiment in the stock came after the private lender halted issuance of its co-branded credit cards, which came under the partnership with Bajaj Finance. Now, this company, this co-branded partnership of RBL Bank with Bajaj Finance, it was one of the largest in India as they issued about 3.4 million co-branded credit cards. Now, though new issuance will take a backseat, the existing co-branded credit cards will continue to operate just as usual. Now, how did the brokerages react to it? Now, majority of them did cut the target price of the counter, seeing this development just a near-term reaction, but they retained their ratings as they expect the lender to scale up arrangements with the new co-branding partners. First up, your Investec has shared a hold call on the counter, but it has cut a target price to 170 rupees per share. On the other hand, Motilal Oswal was also neutral on the counter and shared a target price of 170 rupees per share on RBL Bank as well. Yatin, while we did see some negative reaction post the development, but the management expects to recover the lost ground by fourth quarter. They expect some new partnerships with M&M Finance and TVS Finance also to kick in, and that could help them, regain the lost cover and the vacuum created by the Bajaj Finance. What do you estimate from this?
I think it's a tough call to talk really about, and especially when a market wherein you are seeing the MFI as well as the personal finance, personal loan segment slightly languishing. Asset quality risks are rising for these segments. I don't know how really the visibility grows for a bank like RBL. Obviously, the management also, hasn't been talking aggressively on growth and the credit card business. So we'll have to wait and watch as to what is the strategy of the management. But yes, the market's clearly not happy. They're expecting the asset quality to deteriorate moving forward, and the results also have shown some bit of weakness versus the market expectations. But from RBL Bank moving to Dixon Technologies, clearly the stock of the day, one of the top gainers in the F&O segment. The news really here is that they have collaborated to manufacture Google Pixel phones in India. This could potentially bring in a revenue potential of nearly 1,500 crores per annum. And we have brokerages like Nomura, which have a buy call on the stock with target in excess of 18,600. Obviously, from the current market price, also the visibility is that a 10 to 15% kind of upside is possible despite today's move, and stock is at a new 52-week high. Nomura believes that the FY26 smartphone sales ramp up could really get in good growth on the revenue front. They have the capability to manufacture premium phones, and Google Pixel is one of those premium phones outside of China, which is now started to get manufactured in India. So it boosts the Make in India program. It boosts the China Plus One policy of a lot of these US multinationals. And clearly, Dixon Technology is one of those EMS players, which is the electronic manufacturer sector players that could have this kind of capability. So probably with Google Pixel in the kitty, we are looking at more smartphone orders which could come in the premium segment, which could help boost their overall revenues.
Yes, absolutely. Even the semiconductor stocks are gaining quite a bit of attraction in recent days. So yes, of course, Dixon Technologies being one of them, and of course, this new partnership that they've come out with. Let's move to the next stock in focus. That is your IndusInd Bank. Well, the stock was down 1%, and it was one of the top Nifty 50 losers as well. This came after Morgan Stanley reiterated its equal weight call on the counter and slashed the target price to 1150 rupees per share from 1400 rupees per share. Now, the stock has already corrected 30% after its dismal Q2 performance, and Morgan Stanley analysts believe that there is room for further downside from here on. The bearish stance has come due to the stress in its microfinance loan segment that was evident in Q2, which led to higher provisions, lower asset quality, and even narrow lending margins. Yet then, after a poor Q2 show, looks like the tough road ahead is firming up for the lender, even when the management in its earnings call said that the Q3 performance might look better. We were discussing about the stress in MFI and the asset quality and the higher slippages that come with it. So it looks like, it's a rocky path ahead for IndusInd Bank.
Clearly, and I think the entire MFI segment is going a lot of changes. We have SKS Microfinance, which is now Bharat Financial Inclusion, which is now merged into IndusInd Bank, and with the kind of asset quality stress which we are seeing on the ground, the recoveries are next to impossible. A lot of changes are happening in terms of regulation. Also, RBI is not really keen at MFI loans accelerating, or personal finance or personal loans increasing so much. Because the unsecured nature of these borrowings clearly is something that the markets are not liking now, given the fact that all such transactions are now leading to a pain in the asset quality. So in the Q2 numbers, not only the management toned down the growth guidance, but also the kind of stress they are looking at. So which has led to this kind of derating. In fact, post the Q2 numbers, the shares have already fallen more than 25%. And as you're mentioning correctly, that it's a rocky road ahead for IndusInd Bank. Let's see how they are able to take the MFI business moving forward, especially in terms of the recoveries that can be made now.
All right. With that, we have a great day for markets today. December series have kicked off on a positive note. We'll see whether or not it is sustainable throughout the series as well. But with that, we have come to an end of this edition of the Closing Bell. It's a wrap from Yatin and me. Thank you for watching, and stay tuned to moneycontrol.com for all the news updates and market insights.